Hello, guys, and welcome to PRS. My name is Tire, and I'll be your educator for today. Okay, so today we are going to continue with group accounting. However, we're going to look at it in more detail. Yeah, we're going to look at it in more detail, and we're also going to do a question that they did last year. So, the question that they did for assessment 4 last year to help you prepare for the fourth test. So, before we start, I just wanted to go through the approach again, since we are doing a scenario, and this will help us when you're doing the scenario. So, the first thing is perspective. So, when you're reading the scenario, it's very important to know who are the persons involved there, and basically, whose accounting records are you doing, and then from what perspective are you actually doing that accounting. Then the dates are very important. So we have to track also the dates. And then the standards that we work with, I will explain as I go on today in detail what standard applies where. And then the trigger, the trigger for group statements, like I said, is when an entity buys a stake in another entity, right? That's the trigger. So when you see an entity buying a stake in another entity, so a stake is a share, or maybe buying the entity's assets and liabilities. So um, if you see an entity just buying something like an interest from that business, then you know that's the trigger. And then now today we are also going to dive deep into the scope then, right, of it. So whether this thing we are going to account for it via control, joint control, or significant influence. And after we've determined the scope, then we're gonna do the implication. The implication is now that we know it's control or significant influence, or joint control, how do we recognize it, or when do we recognize it, and how do we measure it, right? What model do we use to measure it? So I'm gonna start in. Okay, so this is the trigger. I said trigger, when you see an entity buying a stake in another entity, then you know it's triggering you to think of group statements, right? So either it's group statement or IFRS 9, right? Then so what happens? Firstly, an entity buys a stake in another entity, right? We said when an entity buys a stake in another entity, then the first thing that entity A must do, right? The entity that bought the stake, meaning the investor. Entity A is the investor, entity B is the investee. So the first thing that the investor must do, entity A, is determine the degree of influence it has in entity B, right? The degree of influence it has in entity B. Like I said, we didn't cover this last week, so I'm gonna cover this now. What is this degree of influence, right? And how to determine it. You will see when you're determining the degree of influence, the first thing that you have to determine is control, right? Whether you control the entity. So what happens is when you buy a stake in an entity, the first thing you have to determine is, do you control that entity, right? And if you don't control it, then joint control. If there is no joint control, then you check for significant influence. However, for at your level, I'm not sure. I don't think BCom you guys do joint control and significant influence, right? And because of that, I'll do these two topics, so how to account for them or scope them on demand. So you have to tell me when you guys are doing this. I don't think you guys are doing joint control and significant influence. And then no influence, this is just when you have a normal investment, and they can also measure it via IFRS 9, right? So the first thing we're gonna do here is, like we said here, when an entity buys a stake in another entity, we determine the degree of influence and what control. So we're going to determine control. So how do we determine control, right? Now, we have to firstly define control, right? To determine whether we control an entity. So what is the definition of control? So control is when does an investor have control on an investee, right? So investor has control. So an investor controls an investee when it is exposed to or has rights to, right? Number one, variable returns from what? From its investment with the investee, and has the ability to affect those returns through its power over the investee, right? Now, this definition you should know, right? You should know, I would say verbatimly, right? And write it in a test. So if they say determine whether like the degree of influence or determine whether in this entity control that entity, you have to write this definition because they give you marks for this definition. I think around 2 to 3 marks for this definition alone, right? Without actually applying it. So we have to know it, right? And then when you apply it using these 3 elements, right? So as you can see to this definition, there are 3 elements to this definition. What did it say? It said number one is power, right? Because it said so an investor controls an investor when is exposed to or has rights to variable returns from its investment with the investor and has the ability to affect those returns through its power over the investor. So we have to determine what is this power, or how does the investor have power over the investor. That's the first thing, right? The first element. And do you see the second element? It says variable returns, right? So we have to make sure that we are exposed to these variable returns, right? Not fixed returns, but variable returns, right? I will explain that one after. And then after, the last thing is the third one is just a link, right? So can we use that power that we just determined to affect these variable returns, right? We just determined that. That's the last element to it. So do you see from its investment to the investing, right? That's the last element. So the first one is power, and power is the first and most important one. Yeah, so power is the first and it is also the most important one. You'll see majority of the marks for identification purposes for control will come from power. These two will get maybe a maximum of around 4 to 5 marks in total, but the majority of the marks come from this power here, right? So we have to know what is power. And so what is power? So when does an investor have power over the investor, right? So power, what is power? Power are existing right that give the current ability to direct relevant activities. So that's power. That's the definition of power is existing rights that give the current ability to direct relevant activities. Now, before we continue, firstly, we have to determine what are these relevant activities, right? Because they use the term relevant activities, right? Because we know that if we have existing rights, right, and the current ability that gives us the current ability to direct the relevant activities, we know that we have power. However, before we start, we have to know what are these relevant activities. So relevant activities are activities that significantly affect the investor's return, right? So now imagine, right, this entity A, when it invested in entity B, why did it invest in entity B? You invest to get a return, right? You invest in something to get a return, right? So it invested in this business and became a shareholder. Why? Because it wanted a return. And this return, how is it affected, right? It's affected via operational decisions, number one, right? So operational decisions affect the returns, right? Decisions like who are we going to sell to, the cost of the business, right? Those decisions like where are we going to buy our materials, how much are we going to buy these materials, where are we going to sell? Those are all operational decisions, right? And so that's the first class that affects investors' return, operational decisions. So if you see like operational decisions, right, and you'll see sometimes you may have like different sets of relevant activities, right? You have to choose the one that most significantly affect the returns, because the first thing you have to do when you're doing this thing, so when you're starting to answer, is determine what are the relevant activities, right? What are the relevant activities, right? And like I said, it can be operational decisions. And if there are no operational decisions, the second class of relevant activities are financing decisions, right? So what finance do they use? Whether they use more of equity or liabilities, that decision also affects their returns, right? But the first level of decisions that affect returns is operations. Obviously, how the business operates, right? Where are we gonna, who are we gonna sell to? Where are we gonna buy our stock and materials, right? So so relevance of activities, what affects the investor's return, and I cannot like stress this enough. Check what affects the profit. The return is basically the profit. What decisions do they take in that scenario that affects profit the most? Those activities are relevant activities, right? That's the first thing, to know what are relevant activities, right? Now, what is power? Now that you know these relevant activities, you have to know who directs these relevant activities, right? Now, these relevant activities can be directed in two ways, right? Via number one, voting rights or complex arrangements. Now, the first one, voting rights, it's the one that you are used to, right? Via voting rights, it's simple. If you have a majority stake, right, in terms of like decision making, then it means that you control the business, right? If you have a majority stake in decision making, so in decision making, right, then voting rights, right? So in most cases, I don't want to say in all cases, but in most cases, like if you have obviously more than 50%, then you control the business. However, you can also control the business with a stake less than 50%, right? And I'll show you how, right? Mare, this voting rights basically it's majority. So it's looking at who has majority of these voting rights. So voting rights is decision making rights, right? So who has more of these decision making rights, right? And you have to have the current ability, right, to use them, right? These voting rights. And I'll go to these voting rights because they like using voting rights at your level. And then the second thing is this relevant activity. So it can be via relevant activities. I said relevant power is the current ability direct relevant activities I get. And these relevant activities can be directed via voting rights or complex arrangements, right? Voting rights, how exactly do they direct these relevant activities? Remember, if let's say as a shareholder you have voting rights, when are you gonna vote? Most probably in the AGM, right? Annual general meeting. You are going to vote for your directors. So you're gonna choose directors basically, right? And what do directors do? Do you see directors? They direct relevant activities. That's what they do. They direct relevant activities. So if you can appoint directors, right, via these voting rights, right, then that means that indirectly, what do? You do direct these relevant activities. So you have power, right? You have power if you can direct basically so instruct basically that I want these many directors, right? So that's voting rights. That's how they work in most cases. So you have an AGM, we are gonna vote. Obviously, if I have a majority vote, I can put the directors that I want, and that the directors that I want will make decisions that I want, right? So therefore, we have the power, right? And then the second one is complex arrangement. So with complex arrangement, it's not with voting rights. So with complex arrangement, it's when that first example I gave you. So it's when they give you straight the relevant activities. They tell you that these are the activities that they do, right? So it's simple. With complex arrangement, the first thing you do is determine what the relevant activities are, right? Who controls the relevant activities in that entity, and who appoints the people who control the relevant activities in the entity, right? Because sometimes in complex arrangement, they can tell you that you have the right maybe to appoint 4 out of 10 directors. Then that means that you don't control the entity still, do you see? Even though they didn't say anything about voting rights. So the first thing you have to do is relevant activities to check how these relevant activities are determined. Is it via voting rights or complex arrangement, right? And then now with complex arrangement, it will depend on the contract, right? And they don't really like much of the complex arrangement, like they don't like questions with complex arrangements, right? However, it will depend on the question and it will be self-explanatory. All you have to do with these complex arrangements is to see who directs relevant activities, right? Now we're gonna go to this voting right issue. So with voting rights, so let's say these relevant activities, they tell you that they are directed via voting rights, right? So the first thing is if that contract, right? So they tell you that you have voting rights and includes potential voting rights, right? So what are potential voting rights? It's either they are options or convertible instruments, right? And what are options? Options basically it's a right, right? You have it's a right that they give you to buy, right? Those shares, right? So they're giving you rights to buy those shares at a specific price, right? Then the convertible instruments, I'm sure you've seen them before. So it's those instruments, maybe they start off maybe as preference shares, and then they tell you that at the end, you have the ability to convert it into ordinary shares, right? So that's potential rights, potential voting rights. Now I'm going to explain how it relates to this, right? If they tell you, let's say I'm giving you an example, so they're telling you that you bought 40%, 40% right of this company, and they are using voting rights, right, to determine to direct, so who directs relevant activity. So it's not a complex arrangement. They're using voting rights, and you bought 40%, right? You bought 40%, and um they are using voting rights. So you bought this 40%, right? And then what happens is that they tell you that you have potential voting rights. So these potential voting rights, they can be options. So they tell you maybe you have options, ne? An option to buy 20%, right, of the ordinary shares. So you have a right to buy 20% of the ordinary shares. Or they tell you maybe that you have preference shares, and these preference shares are convertible to 20% of ordinary shares. Like when you calculate it, it's convertible 20% of ordinary shares, right? Do you see? Do you see that what happens is, ne, this thing, like the entity, the investor, if he wants, ne, he can convert these options or convertible instruments to 20% and add it to his 40. And then what is he wanna do? Have the 60%, meaning that he does actually control the entity, right? However, ne, he only controls the entity in this scenario if these options, right, or convertible instruments are currently, so these convertible instruments, you can convert them now at acquisition date. Now you have to be able to convert them now, right? And these options too, you have to be able to exercise them now at acquisition, right? If you are unable to exercise them at acquisition, right, you don't consider them. Because why? They said power is what? Existing rights, right? So number one, they do exist. That give what? The current ability. Do you see? Current ability. So do you see that if you don't have the current ability to convert it, you won't have the current ability to direct relevant activities. If they say maybe in the next 2 years, then you're going to have the current ability to direct relevant activities in the next 2 years, not that year. Do you see? So therefore, this thing has to be exercisable at that point at acquisition. They have to be, if they tell you about a future date that you can only convert in maybe 2 years, or you can only purchase these shares using these options in 2 years, then that means that you only own what, 40%, and therefore you don't control the entity. You see, yes, that's the first part for the voting rights. And then they said they must be substantive rights, right? Meaning, so all voting rights, including potential voting rights, they must be substantive, meaning rights are currently exercisable, like I said, currently exercisable, and the holder must have the practical ability to exercise. Now, this point is also very important. So this one here is very important. This point here is very important. Practical ability to exercise. So let's go back to this example. Ne? So let's say these options are currently exercisable. Ne? So you can exercise them and get this 60%, right? However, when you're looking at like your company, you don't have like enough resources, right, to actually purchase this. So to actually exercise these convertible instruments, even though they are convertible, but you as a company, you don't have like enough resources to purchase it. You don't have maybe enough cash or assets, or you can't really issue instruments to them. So you don't have enough resources to purchase the 20% at this point. So do you see that you don't have the practical ability to exercise that particular option or convertible instrument, right? That means that that right is not substantive, and these rights have to be substantive, right? Right. So do you see that you don't have the practical ability to exercise, right? That means that you don't have the current ability to direct relevant activities. Do you see that all of these things are just explaining this thing better, right? They are just explaining this thing more, right? So this is basically it for voting rights, right? So for voting rights, you'll see these rights, they, in the end, you see that I was talking about directing relevant activities. So these rights have to direct relevant activities, right? And therefore, by this, you have power via voting rights. So that's all they can ask you basically with voting rights. And then So that's how you determine power via voting rights. And then with complex arrangements, I already, like I said, the contract there itself will give you what relevant activities are. So, so what are the relevant activities? You have to basically ascertain what are the relevant activities and see who directs them, right? Who currently has the ability to direct them, right? Right? Yeah. So that's basically it. Like I said, complex arrangement, entities designed so that voting rights are not the dominant factor in deciding control. Right. So I hope you got it. And then after this, so this is all IFRAS 10, right? Because we're determining control. Do you see? After all of this, now we've determined what? The scope, right? We are done with the scope. So now, no, we are not yet done with the scope. You see, I even forgot the last element. What did you say? We said there are three elements. So we are done with power. We've determined that we have power over entity B. However, not control. So we have to now continue. How do you continue? We have to firstly check that these returns are variable, right? So how are returns variable? You will see if it's a normal business. So a normal business returns are variable, right? Because they vary as a result of the performance of the entity, right? So obviously entities perform differently from year on to year on. Businesses do not operate the same from year on to year on, even though they are similar, but you don't expect the same thing to happen, exactly the same thing to happen from year on to year on, right? So here they're not including in. So do you see that they are not including preference shares here, right? Because preference shares have a fixed return, right? So if it's preference shares, it won't work. Even though you do control those shares, if it's preference shares, it's going to be fixed returns because you're expecting a certain percentage, right, every year. So here, these returns must be variable, right? And you'll see in most cases, this is not the issue. The issue is the power, right? So that's why determining power is the most important. Here, maybe 2 marks, nyana, one. And then after this element, after determining that the returns value of that business are variable in nature, right? You just now link this power to return. So you just say how entity A can use its power, right, to affect those returns, right? So can say something like because entity A, right, has control over entity B, right? Entity A, right, can direct relevant activities, right, in such a way, right, to affect those returns, right? Because that's the actual truth. We can use his power, right, to direct relevant activities, and these relevant activities, what do they affect? What do they affect? We said relevant activities are what? They significantly affect returns, right? So they all link up, and then after that, you've determined control. Now you control that entity, right? You control that entity. That means that with the scope, we are done. So with this portion of the MM approach, we are done. Now we know that it's control, right? So we can move on to implication. What do we do now that we know that we control this entity, right? Okay, so I want to. So after determining the level of influence, right? So now we've got control, right? We have to account for the investment, right? So now before you start, you have to consider. So after you have control, so the first thing you have to do when you are doing so after you control the implication, the first implication you're gonna do obviously is business combinations, right? To check whether this thing that you control, right? Because you determine control, you have to check that this thing that you control is really a business before applying IFRS 3, right? Because IFRS 3 applies when what happens? It applies when an entity buys another entity, right? Not just in the other entity's assets, right? So the first thing you determine that this thing is an entity. So also that one doesn't have like mini marks, right? And they don't really ask that one much. They don't really ask that one as much. So maybe 2 marks, right? And determining that something is a business is simple. A business has input, right? You have input, right? And then there's processing where you process that input, right? So I would say maybe inputs are if let's say you are you're doing poultry farming, so so chicken, you're dealing with chickens and eggs, right? So what's going to happen is that your input obviously is going to be your chicken, the feed, the structure in which you keep those chickens, right? And then the processing is actually when you take care of the chickens and everything, and then the final product, the output is the egg where you actually sell. So a business has to have some sort of so those components, right? Even so it has to have those components, right? It has to have those components. Like even with us here at PRS, like for instance, we use notes obviously taken from different like institutions and then put them into one. So that's processing and then something coherent to help you pass. So that's our output. So that also it's not very hard to see, right? So it has to be a business. So if from the onset you can see that thing is a business, you don't even need to go through this process because you can already see that this happens, right? And then number two, after it is a business, you have to consider that you have to consider all the assets and liabilities that you bought in that contract, right? That's very important. So that contract covers a specific scope of assets and liabilities, right? And you must make sure that you only account for those assets and liabilities in the investment, right? For like that relate to that business. Let me give you an example. Let's say you own maybe um let's say yeah, you own maybe let's say a tattoo shop, tattoo shop maybe, right? Now what happens is in this tattoo shop, I buy your shop, I buy your equipment, I buy everything, right? And then you have maybe a bicycle outside, right? Now this bicycle, right, it's not it's not used like in the business, not part of the business, right? Because not part of the business, we must not see it must not be part of the business's asset. So what you're gonna do is you're gonna isolate the transaction between that bicycle and the business because the business is only assets and liabilities relating to the business. Ne? And then after you have all of that, then you can consider IFRS 3 because you have a business and you have control over that business. Therefore, those two businesses are combining, so it's business combinations, right? So business combination. So um when do you record transaction for business combinations? In sort of two dates, right? I hope you wrote these two dates down. So number one, you recorded at acquisition. So when you acquire the business, you have to do a frustrated transaction. And then it is also the first part of consolidation, right? When you're consolidating, a frustrated is also there, but the first part, right? Now, I say the frustrated is from at acquisition, right? So let's continue. So now after we've determined well or like this entity controls that entity and that thing really is a business, a parent must prepare consolidated financial statements, right? So if you're a parent, you must prepare consolidated financial statements, right? Then they have rules for unless, so there are some rules. So if you're a parent, not so you may choose not to prepare consolidated financial statement. There are some rules there. However, this one is not really important, right? What's important about it is here in this first point. So what's important about this consolidation, whether a parent prepares consolidated financial statement, is this first point here, right? We first determine control, right? We control the entity. We determine that this entity that we control is actually a business, right? Now we have to determine the final thing now here before now we start really with journal entries. And that is, are we going to prepare consolidated financial statements or not? Right? That's what we have to determine. Are we going to prepare consolidated financial statements or not? Right? And um, basically, the way we do that is firstly, we look at how the entity was purchased, right? Firstly, if you purchased, so if the entity, you purchased 100% of the entity, right? So 100% of the entity was purchased, right? Then that means that so if 100% of the entity was purchased, that means that you have a choice whether it can be consolidation or you have no consolidation, right? So you can have a choice between having consolidation and no consolidation, right? So how does that happen? So this 100% interest in the business, you can get it in two ways. It's either you can buy 100% of the shares in that business, or by purchasing the assets and liabilities of that business. So there's two ways you can get 100% interest in the business. So firstly, I'm gonna start explaining this purchases of assets and liabilities, right? Because you are purchasing the assets and liabilities of the business, right? You can record these assets and liabilities of the business in the separate financial books of the business. So if a question said you purchase the assets and liabilities of a business, most probably there's no consolidation there, and you have to record goodwill in the separate financial books. Yeah. And then if there's a 100% stake, then there's a choice. You have a choice whether you can record the assets and liabilities in the separate financial books or consolidation, right? So the choice only appears if like it's a 100% stake. However, if it's not a 100% stake, so it's anything other than 100%, right? Then you have to prepare consolidated financial statements. No choice. They are consolidated financial statements, right? And then now I'm gonna come here to the next one. So here, when you have control, so 100% control, but there's no consolidation, right? So you have this 100% control, and maybe they told you that you bought your assets and liabilities, or it was 100% shares, and they chose not to consolidate, right? So what's going to happen is, firstly, what does business combination say, IFRS 3? It says you are going to firstly record, right, the net identifiable assets and liabilities at fair value, right? That's what it says. So that's what you're gonna do here in the journal entry. And this journal entry, you're gonna do it at acquisition, right? So if you have 100% control and there's no consolidation, what's going to happen is that in the separate financial books at acquisition, you're gonna have this journal entry. Because what did I say? I said if frustrated, either you have journal entries at acquisition or beginning of consolidation, right? So this is the at acquisition journal entry that you're gonna process. So at acquisition, at the date acquisition, right? So firstly, you're gonna debit the assets of the sub at fair value, right? Don't forget, in the question, they might give you these assets of the sub at cost and the fair value. Do not forget that here you record the fair value because it says fair value of the net identifiable assets, right? So now, what is identifiable? So assets that the entity can identify. So basically assets that the entity can see or can calculate, so it can identify using the identification criteria, right, in certain standards, right? All of those assets that they can identify, then you debit, then you credit what liabilities, right, at fair value that you can identify. So identifiable liabilities at fair value. So do you see that this identifiable assets minus identifiable liabilities, it gives you net identifiable assets. So that's what they mean every time when they say net identifiable assets, right? They mean identifiable assets minus identifiable liabilities. And identifiable just means that the entity, right? The entity is able to identify them, right? Using the identification criteria in various standards, right? And then we have this credit consideration at fair value, right? So we have to credit the consideration also at fair value, right? So we credit this consideration at fair value. And this consideration, like I said last time, it can be there's a lot of types of consideration. So you can consider you can use assets as consideration, you can use cash as consideration, or you can use instruments, right? So things like shares, bonds, or even a loan, right? A loan is an instrument, so you can use assets, cash, or instruments, right? Then that's consideration, and they may also be at fair value, right? Fair value. And then what happens is, now I want to explain this goodwill or gain on buying and purchase, right? So let's look at here, right? Let's say here you debited 100,000 assets, right? So this is 100,000, right? So in total, all of these assets, when you debited them, they equal to 100,000, and their liabilities equal 80,000, right? So what does it mean? It means that the net identifiable assets are going to be equal to 20,000, right? We agree on that, right? And then the consideration, let's say the consideration at fair value in total was equal to 30,000, right? It was equal to 30,000, right? So what does this say? Do you see that the net identifiable assets is it's 20,000? However, we bought it using 30,000, right? In my last video, I explained what goodwill is, right? That a business, it's not only its assets, right? it's also how those assets work together to produce the returns, right? That's very important because you can have two businesses that have the same assets, but in terms of performance, they are not performing at the same level, right? It obviously, if let's say you have two businesses, right, where business one and business two, they have the same assets, right? However, business one is performing better than business two. That means that the consideration that you're going to pay for business one is going to be greater than for business two, right? And you see that because you are paying more, right, for these assets, what you are paying for is this. You didn't make a loss, right? Because you bought it at a high value. It doesn't mean a loss, right? Because this seems like a loss. You made a loss, but you don't make a loss, right? So where is this 10,000 attributed, right? This 10,000, because there's a 10,000 different. Where does it go, right? This 10,000. Remember that it's a debit balance, and a debit balance, it's not an expense in this time. It's going to be an asset called goodwill, right? Because like I said, in a business, right, it's not only the assets value that counts, right, but also the synergies of those assets. So how those assets work together, right? Please go to last week's video for more information on goodwill, right? And then, which means in that case, you're gonna what, debit 10,000 goodwill, right? And then let's give you another example. Let's say the consideration this time was 15,000, right? So it was 15,000, right? So what does it mean? Do you see that this is basically the value of the asset, the net identifiable assets? This is basically the value of the business, right? So you see a total value of the business according to the assets, right? Total value of the business according to the assets, 20,000, right? So you're buying a total net value of assets of 20,000, right? But you are buying it with 15,000, right? Do you see that in this case, right? This is definitely a gain, right? Because we got more value from these assets than we purchased, right? And that's a gain on bargain purchase. And a gain on bargain purchase is profit, right? So remember, goodwill is not an expense, it's an asset, right? However, gain on bargain purchase is a profit item, but profit item for when? At acquisition, right? Profit item at acquisition, right? So when you acquired this, so this year will be P&L, right? Yeah. And then this is what happens. So this is what happens if it's control of 100% and there's no consolidation. So that's what they mean when they say you're gonna have goodwill in your separate financial books. Why? Because this general entry, where you're gonna do it, you're gonna do it in the financial statements of the parent, right? Not and consolidation. What does it mean? It means group, right? So group level, not only separate parent level, right? And then that's basically how you do it when there's 100%. And then if it's not 100% acquisition, right? So if there is consolidation, right, what will happen at acquisition? At acquisition, what will happen is now this journal entry, not this journal entry, right? So this is when there is consolidation, right? And this is the normal one. Normally, what's going to happen there is going to be consolidation, right? So we're going to process the following journal entry, right? Remember, during acquisition, you did pay off something, right? There's this consideration that you have, right? So at acquisition, what you're gonna do is you are gonna record the consideration normally, right? So this recording of the consideration, you're gonna do normally. So this is the same as this, right? Now do normally the fair value of it. However, you're gonna debit investment in subsidiary or investment in B, right? In that entity. So that's where you're gonna take the consideration, right? So this investment, right, amount will always be at cost, right? Then in some questions you will see they'll also put it at fair value. So if it's at fair value, that means that it was firstly determined like this at cost. Then as time went on, they were busy like changing the value of this investment via fair values, right? But I'll show you like an example, right? So what's important to note, right, is do you see that the assets and liabilities are not created here? Nothing from the subsidiary really is in the separate books, right? Really nothing from the subsidiary, because it's this consideration, and this consideration is just what we paid, right? Yeah, it's here. And then that's basically it. Like that's for infrastructure and acquisition. Infrastructure and acquisition. So this is what happens. Now, at the end of the period, what will happen? The parent will consolidate. And do you see that during this? So when this happens, do you see that in the subsidiaries like records, there's nothing that's going to be recorded when this transaction happens, right? Because the parent is buying shares in the subsidiary, right? And unless these shares are still like issued, and they won't give you that example where the entity is actually issuing shares, right? These shares are always bought from another investor, right? And if they are bought from another investor, do you see it has nothing to do with the subsidiary? So there is no share capital, no nothing for the subsidiary because they already issued those shares. It's just two investors trading, right? So it's just two investors trading. So for the subsidiaries records, there's nothing in the separate, right? Then now we're going to reporting period where the parent will consolidate. So now starting with this consolidation process, right? So um because we are starting with this consolidation process, we have to know what is to consolidate, right? So to consolidate basically is you go from combined journal entries, right? Combined journal entries to consolidated journal entries. And this process is consolidation, right? So consolidation, what does it mean? It means that looking at things from a group level. That's what it means. We are looking at things from a group level. So from a group, this is from a group level. That's what consolidation means, from a group level. Ne? And then, like I said, when we consolidate, we go from combined to consolidated. Via what? We consolidate using these entries called pro forma, right? Pro forma. So we use these journal entries called pro forma journal entries, right, to consolidate, right? And what do these pro forma journal entries do, right? They do two things. Pro forma journal entries, they fix, right? They first fix the discrepancy and then they allocate and allocate. And I have to do this illustration again because it's very important, right? To see what they really fix, right? So we have this entity A here and entity B, right? So we have entity A here and we have entity B here, right? So let's say entity A sells to entity B, right? And then this is obviously the entity. This is on a group level, right? This is group. This is the A group. So this is the A group, right? This is the A group. This whole group is the A group, right? So what happens? Let's say A sells to B, right? So um so in A's separate financial books, right? A is going to record a sale to B, a normal sale, right? And then B is going to record a normal purchase, right? Right. That's what they're going to record, right? However, let's look at it from a group level. From a group level, from a group statement level, what happened here? Nothing. Do you see? Nothing happened because nothing was transferred outside to outside parties, right? This stayed here. So do you see that the way that the group recognizes transactions is different from the way that these two entities recognize these transactions, right? Because there's a difference, right? We have to fix. That's the difference that we are fixing. We are fixing this, right, to a group level, right? Why? Why do we say we fix, right? Because we are treating, so from a group level, what does it mean from a group level? So group level means that we are treating entity A and entity B like the same entity. So they are the same entity, the same entity. So there's no difference between A and B. That's what it means from any group level. That's why here I just contain them in one circle. Do you see? This thing is one entity. So you can't sell to yourself, right? So therefore, this transaction, that's why I'm like, this transaction, it didn't happen on a group level. So this is one of the transactions that you're going to be fixing. So this is why we do this thing, right? And then to consolidate, so where do we start? Yeah, so it's very important. Now we're going to start with the consolidation process, right? The whole consolidation process. So where do we start when we start with this consolidation process? Now, it's very important to know that do not forget these journal entries, right? In the separate, what happened in the parent. The parent currently has this investment, right? He only has this investment, right? Like in terms of like information concerning the subsidiary, it only has this investment currently in its books, right? So, however, what will happen, right? The starting point of consolidation is that the parent is firstly going to add everything from the subsidiary, everything, assets, liabilities, equity. It's just gonna add profit, add everything together. So 100% of the assets, 100% of the parent, 100% of the subsidiary. So the parent is going to add 100% of the subsidiary in their records, right? That's the first thing that they're gonna do. So all of the assets debit to the parent, right? Liabilities credit to the parent, equity credit to the parent, profit credit to the parent. Everything is just going to be transferred to the parent first. That's the starting point, right? This is where we actually combine them, right? You see, this is where we actually combine them. But this process, like in most cases, like you won't even see it like in a test, right? You have to just know that it is there, right? So starting point of groups is that we add 100% of the liabilities, assets, and equity of the subsidiary. Why? Because we are saying we and the subsidiary are the same entity. That's why we are adding everything together. That's where we start, right? But do you see that that's very rudimentary, right? Because why? Because what happened during the year um does not correctly is not correctly represented in these separate financial books, right? In these combined books. So starting point is to combine, right? And what do? We do these pro forma journal entries. So we allocate what to come to this group level consolidated financial statements, right? So now that you know the starting point, that's why even for these starting points, these journal entries, you won't see them anywhere. Like you won't even record them. Why? Because in most tests, they're gonna say prepare pro forma journal entries. And this starting point is not a pro forma journal entry. Do you see why? Because it does not fix and allocate. It's the one that's actually starting, that's doing this, it's combining these things, right? Yeah. And then we start then. So now that you added everything together, right? Now you wanna fix everything. That's the reason why you're doing these profit margin entries. So if you wanna fix everything, where do you start with the fixing? You have to start from when you acquired the business, right? That makes sense. That's why we start at acquisition. So from when we acquired the business, right? What went wrong, right? So think about it properly, right? Like I said last week, when we acquire for a business, right? We have to acquire that business, those assets and liabilities at fair value, right? Fair value. And you know that not all items the subsidiary is going to record at fair value, right? You know that not all items the subsidiary is going to record at fair value, right? So what happens is you are going to take um these are you have to now adjust, right? Because what happened is that at acquisition, the subsidiary now has all of these amounts wrong, right? Because at acquisition, it had things that cost and maybe they had to be at fair value, and therefore you have to adjust it. That's the first mistake that they made. That's the first thing that you have to fix, right? And then also on those fair value adjustments, don't forget that there are also items that the subsidiary, right, didn't recognize. And I'm still at acquisition. At acquisition, they didn't recognize, right? However, they have to be recognized via the business combination. So IFRS 3 rules, right? They have to be recognized via those rules, right? So here it's, if I can give you an example, let's say the subsidiary, right? So the subsidiary, the subsidiary had PPE, right? So PPE in most cases measured at cost, right? So PPE 80,000, right, at acquisition, right? Then the fair value of that land, when you calculate as 100,000, right? Of that PPE, I mean 100,000, right? Do you see that the PPE was undervalued, right, at acquisition by how much? By 20,000. So what we have to do is we have to start with a journal entry that adjusts for that mistake, right? Because it was undervalued, we have to value it, right? We have to increase the value of it. So debit PPE with 20,000, right? And then credit what? You're going to credit this account called equity at acquisition. So this equity at acquisition, it's an account where we accumulate all of these profits and losses that we got at the beginning of the year, right? And what do I mean when I say profit and losses as a result of these fair value adjustments, right? Think about it properly. If the subsidiary has recorded the PPE as 80,000, right? And from our point of view, that PPE is actually worth 100,000, right? Do you see that we are actually profiting like 20,000, right? So we are getting 20,000 extra basically from this deal, right? That's why we have this equity acquisition, and you see it's credited, therefore it's going to be profit then. However, it can also represent a loss, right? So if let's say the PPE was overvalued, so it was 100,000 here, and the fair value is actually 80,000, then that means that PPE is gonna be credited, right? And you're gonna debit equity at acquisition. Now, do not forget, because you're in a third year level, you already did deferred tax, right? Deferred tax for groups, trust me, it's very simple. You must just not forget it, right? So for this one here, what you're gonna do is that the deferred tax is just gonna follow the equity acquisition at this point. So if equity acquisition you debited, the deferred tax you're gonna debit. If equity acquisition you created, the deferred tax you're gonna credit. And firstly, right, what you're gonna do is you're gonna debit, right? Let's say in that example where you debited the PPE with 20,000, you're gonna debit that PPE, right, with 20,000, right? And then what's going to happen is now let's see what we credit, right? So firstly, in this case, we are just going to say that 20,000 multiplied by the 28%, right? The deferred tax, and then deferred tax is 5.6, right? That means that equity acquisition is going to be 14,400, right? So that's what you credit, right? And then don't forget, if it's something like land, right? If it's something like land, don't forget that you don't multiply by 28%, you multiply by 22.4%, right? Which is basically that 80%. So it's basically the same as saying 20,000 multiplied by 28%, right? And then multiply by 80%, right? Right, since land doesn't have depreciation and the temporary difference only amounts to the 80%. If you want more guidance for doing deferred tax, I did do a video on it. Please watch it. And then so yeah, those are fair value adjustments. And then like I said, there are other adjustments, right? Like for instance, items that are not recognized in the subsidiary that, but the parent recognizes. Why? Because of IFRS 3 rules. Like I will write all of those basically conditions down for you so that you have them in a list. But you gotta know them. Like things like contingent liability. Like for instance, in the subsidiaries record, right? That contingent liability is disclosed, right? However, business combination says as long as that contingent liability you have a reliable estimate for it, then you can recognize it, right? So what you're gonna do is you're gonna say contingent liability you credit, right? And then what are you gonna debit? You're gonna debit equity acquisition and deferred tax. Do not forget deferred tax, right? So those are the general entries at acquisition. Do you see that we are still fixing things at acquisition? So the fair value adjustments and the assets and liabilities, they are not recognized by the subsidiary, but we as parents, we identify them. So they were not identified by the subsidiary, but we as parents, we identify them, right? So those are the adjustments that you have to do first. Do not forget deferred tax. Deferred tax just follows the equity at acquisition, right? This is the last example. So even something like intangible assets, right? So intangible assets here, obviously, they have to be identified and recognized, right? However, there's a rule here in IFRS that says that even if they don't meet the recognition criteria, as long as they can be identified. So as long as you can identify an intangible asset here, right? Obviously, the sub won't have it, right? And you have to record it, right? So you are going to say intangible asset, you debit, right? And then equity acquisition, you credit. Don't forget deferred tax, you also credit at that point, right? And then that's the first type of journal entries you have. So I call them at acquisition journal entries, right? At acquisition journal entries, because that's exactly what you're doing. You are filling up that account, that equity acquisition account. Do not forget deferred tax, because do you see it affects the amount of equity at acquisition, right? So that's the first set of journal entries you have, right? So do you see that these journal entries, all of them, they just fix the discrepancy, that discrepancy, right? And then after these journal entries, the next set of journal entries you have are called main elimination journal entry. So the main elimination journal entry, right? So it is the main elimination journal entry. So with this main elimination journal entry, right? This is the journal entry you're gonna use basically to let me go here. I wanna just go to it. It's the journal entry you're gonna use. So this journal entry, this main elimination one, is similar to this one, right? Because this main elimination journal entry, you're gonna use it to recognize the goodwill, right? So here do you see for 100% acquisition with no consolidation, the goodwill is in the separate financial books. But here do you see that in the separate financial books, there is no goodwill. However, you're gonna do the main elimination journal entry which has the goodwill. And don't forget this thing, pro forma journal entries are scrapped every year, right? So these group statements are for presentation purposes. So the next year, what's going to happen is that they're gonna be treated as if you didn't do pro forma journal entries at all, and you're gonna start again and again and again, right? Every year, right? So that's why these amounts, like at acquisition and what, they don't change every year, right? So back to this. So main elimination journal entry. So the main elimination journal entry, how do you do it? So how do you actually process this main elimination journal entry, and what is this main elimination journal entry? Like I said, after here, after you're done with the at acquisition journal entries, right, you have to prepare your analysis of equity, because that's very important. In the last video I did cover how the analysis of equity looks. Please go there for more information on that. And then this analysis of equity, so this main elimination how does it look? So firstly, you're going to debit the equity of the subsidiary, everything, every equity item. So retained earnings, share capital, revaluation surplus, market to market. So anything that's in in equity for the subsidiary. Why? Because this thing is also called what, the main elimination journal entry, right? But why do we eliminate it, right? Because you cannot invest in yourself, you cannot have equity in yourself. So as a business, have equity in you cannot invest in yourself, right? And then do not forget that included in this equity here, it's also the equity acquisition, this equity at acquisition, right? So this equity at acquisition is also included here in the equity of the sub, right? So in the equity of the sub here, it is also included in here. And do not forget that this equity acquisition, you can get a debit and a credit balance. And don't forget here, what are we doing by debiting the equity? We are eliminating the equity, because what did we do? At the beginning of the year, we added 100% of S, right, of the subsidiary, right? So we have everything of his, we have his liabilities, his assets, right? And what did we do here? We firstly started off by fixing his assets and liabilities at acquisition, right? And don't forget, we're still at acquisition. So then after fixing his assets and liabilities at acquisition, now we are fixing his equity at acquisition. Do you see? There we are fixing his assets and liabilities at acquisition. Now we are fixing his equity at acquisition by eliminating it, because from a group level, we have to eliminate it. You can invest in yourself, including this equity acquisition. Now, this equity acquisition, do you see that if it's a credit balance, then you're going to debit it here. So it's going to be debited with the equity here. And then if it's a debit balance, then you're going to have a credit balance for equity acquisition. However, if you take the compilation of all of that equity of the subsidiary and the equity acquisition, that gives you the value of the business that you bought, right? So the value of the business that you bought at acquisition. So that's the not that you bought, I mean the value of the business at acquisition. So that's the value of the business at acquisition, right? So that's the value at acquisition, right? And the reason why it's the value at acquisition, why? It's because, let's go back here. Just wanna illustrate with this one. Do you see with this one? I said assets minus liabilities gives us what? basically the value of the business, right? The value of the business. And I want to prove to you why this one also gives us the value of the business, right? This one here also gives us the value of the business. The reason why is because assets, right, minus liabilities gives us what? Is equals to equity, right? And here, you remember I said the assets minus liabilities, they give us the net identifiable assets and liabilities, which is the value of the business, right? This is the same here as here, right? Same here, right? So this is the value of the business, right? But please do not confuse this and this, right? They're not related. I'll just showing you like this thing, that this thing is actually the value of the business, right? And then what happens is the first thing is we are going to, so from this value of the business, right? So this is the value of the business, the entire business, because we said what? We debit the entire equity of the sub, right? And don't forget that we do not own the sub unless we own 100% of the sub, then you won't have this NCI. Ne? So if you own 100%, obviously there's no non-controlling interest, right? So this year, by doing this, what are we doing? We are fixing, you see, we are fixing this equity because it's not supposed to be there. And then by crediting this NCI, what are we doing? We are allocating, right? We are allocating to the correct equity amount. So like I said, pro forma general interest, either you fix or allocate. So allocate to a non-controlling interest. You'll see allocation, it will be allocation to non-controlling interest every time, right? And then what happens is we said, firstly, this is the value of the business, right? And the non-controlling interest are what? Other shareholders, right? Of the business that do not control the business. So let's say you bought 60% of the business, whereas the non-controlling interest is going to be 40%, right? So what happens is this non-controlling interest, this amount, there's two ways to calculate it, right? The first way is using this way, so the net proportional asset, right? So the net proportional asset, right? And how do you do that? It's simple. You just take the equity that you have so the equity that you got from the sub multiplied with the percentage. So in this case, it will be multiplied by 40%, right? Multiplied by 40% at so in that case, right? And then do you see that by doing that, you're actually taking out the portion relating to the non-controlling interest and allocating it to the non-controlling interest, right? Right. So let's say here we have 100,000, right? Uh, that means that the non-controlling interest is going to be 40,000, right? So do you see that already we have so a portion of it has been allocated here. So we are left with what? The 60,000, right? And then what happens is that we credit this investment in B. And where do we get this investment in B? Remember that this investment in B was always there, right? Because we had this journal entry in the separate, right? We had this journal entry of investment. So in the separate, we had this. And what do we know about consolidation? Consolidation says we are at a group level and you cannot invest in yourself. That's why you have to remove also this one, right? But what is this thing? This thing is the investment, and also what carries what? Do you see that this investment, it also has all of our considerations in it, right? So all of our considerations are contained in this investment in B, right? So all of our considerations are in B, right? So do you see that by taking it out, it's so it's the same as saying this is the consideration that I paid, right? So sometimes in questions, obviously you won't have this journal entry, right? Because it's done in the separate, right? However, to calculate this investment, they'll just give you the consideration, like the consideration that they use. And you're just still gonna say credit investment, but do not forget, use that consideration at fair value. So that's why you see with groups, what's difficult about it is that people do not do the whole process, right? So when they do it, like journal entries start popping up out of the blue, and yeah. So I want to show you that these journal entries, they are not done out of the blue, they are done with reason, right? So this thing here is the consideration. So let's say it was 100,000. 100,000 minus 40,000 is 60,000. So the value that you bought from this business is, let's say, 60,000, right? And let's say you invested an amount of, let's say, 70,000, right? So that means that you invested more than the actual worth of the net identifiable assets, because these are net identifiable assets, right? Like I said, the value of the business, right? So you bought more. So do you see that you bought more with 10,000? So you're gonna debit what? Goodwill, 10,000. And then obviously if you bought less, it's gain on bargain purchase credit with whatever amount it is, right? So This is the main elimination journal entry. And why is it called the main elimination? Do you see that we are eliminating the equity? We are eliminating the investment. Why? Because you cannot invest in yourself, right? And then we have to allocate to non-controlling interest and goodwill, right? Like I said, pro forma journal entries are there to fix and allocate, right? So this is the pro forma journal entry you do after this one. So after the adjustments, the main elimination journal entry. And these two journal entries, so these two types of journal entries are called at acquisition journal entries, and they are part of IFRS 3 business combinations, right? Business combination. So this is where business combination ends. So from here on, we are going to go to since acquisition. So we were at acquisition, now we're going to since acquisition. So even in our analysis of equity, we are at since acquisition, right? Right. And because we are at since acquisition, now we're starting with going back to IFRS 10 rules. So this is IFRS 10 rules because we are not talking about a business combining here. Do you see there's no goodwill adjustments or anything like that, right? Now we are accounting for the rest. Right? So we are using provisions from IFRS 10 again. I was just giving you standards. And then the first thing is we have to fix the discrepancies between the assets and liabilities that you just adjusted for at acquisition, right? So what does this mean, right? So this means that, like for instance here, do you see here, what did we say, right? You adjusted, so it's fine. At acquisition, you did well, right? You did well by saying, by adjusting this thing. So let's say this was PPE, by adjusting it, right? And creating a debit balance for it, right? So let's say the PPE here was 80,000 and then the fair value was 100,000 and then you increase the fair value of it, right? So you debited PPE and credited equity acquisition and this deferred tax, right? So what's going to happen is what happened in the separate financial books, right? What happened is that that PPE item, right? For that PPE item, the subsidiary, what does it do to it? It's going to record depreciation on that PPE item, right? Mare, do you agree with me that the depreciation that so the subsidiary is going to record here, right? It's going to be way lower than what the depreciation value is supposed to be, right? Because what happened, the actual value of the PPE is actually 100,000, not 80,000. Do you see? So you have to recognize additional depreciation for that um, um, 20,000, right? So you have to recognize additional depreciation for that 20,000, right? You have to record that additional depreciation, right? For that 20,000, that one, because as time goes on, this one is still going to record the same depreciation, right? However, the value of the asset is actually higher than what it's supposed to be. So you're going to record that depreciation. And obviously, if it's something like land, you won't do anything because they didn't record anything. And even from a group level, there is nothing, right? Right? Because from a group level, that thing was 80, from separate level, that thing was 80,000, but from a group level is 100,000. So you have to record an additional depreciation on that. So let's say the depreciation was 10%, you're gonna take 20,000, multiply by 10% and get 2,000, right? So you're gonna say the first performance entry, you're gonna say depreciation you debit, right, with the 2,000, accumulated depreciation you credit with the 2,000. Why? Because the depreciation here was small. Now you're just increasing it. Do you see? That's why you continue with it, right? And then let's say they tell you something about, let's say they tell you that that after deliberation they've determined that that contingent liability is gone, so you don't have that contingent liability anymore. What you're gonna do, you have to de-recognize it, right? So you're gonna de-recognize it normal and say contingent liability you debit, and then what do you credit? The profit, right? A profit. And then even with amortization, the same thing. So everything that had these fair value adjustments, you just have to see that after acquisition. So do you see this one is since acquisition? So since acquisition, what happens? And so since we acquired this thing, this is the kind of depreciation you've been exposed to, right? And then what happens is you'll see as you're doing questions, some depreciation, maybe it's for last year, right? If it's for last year, you know that where do we take our profits? We take them to retained earnings, right? So we know that that amount will be where retained earnings. So instead of the profit, it will be retained earnings. So which means that instead of writing depreciation there, you're gonna say retained earnings you debit, and then accumulated depreciation you credit. And then this year's one, you're gonna use the depreciation because depreciation goes to P&L, and P&L affects the basically the profit or loss statement. But I will show you that relation with retained earnings, right? And then that's the first set of discrepancies that you solve at since acquisition. So discrepancies relating to this part, right? So you're gonna go back here and see, right, which items here like are further recognized as time goes on, and whether the subsidiary versus the subsidiary in the group, like what did the subsidiary do wrong, and then adjust, right? And then the second set is fix the discrepancy between the parent and the subsidiary, right? Um, so that happened from since acquisition until the end of the current year. So these are obviously items that are not related to that acquisition part. So it's what happened during so since acquisition. So um, intra-group transaction basically. This one is talking about intra-group transactions, right? This fifth one, right? So or changing policy. So let's look at that. So for number five, man, we're still at number five. So I've grouped these discrepancies, right? Because they do group them. So these discrepancies are grouped. So for number five, so the first one is intra-group transaction. They're called intra-group transaction. The second one is difference in policies, right? So, and I'll explain what it means. So intra-group transactions, basically they are three. It's if it's a sale of inventory, right? So selling inventory from entity A to entity B, right? Or sale of assets, right? Sale of asset to from entity A to entity B, or dividend distribution. So entity maybe B distributes dividends, right? So those are intra-group transactions, right? And like I explained with that diagram using those two examples, do you see that because of these transactions, these intra-group transactions, right? That amount will be wrong, right? Just adding 100% of them. That's why we have to do performance journal entries to fix also this. And then also if there's a difference in policy, right? Versus what the sub does and what the group does. So if from a group level, right? A group level, the group says the sub is supposed to record that machine at PPE, that machine at cost, right? Or that machine at fair value, right? They tell you that the policy of the group is to use fair value on those types of so maybe fair value on investment property. Maybe that's their policy to use fair value on investment property. That's the group policy. However, your policy in the separate is to use cost, right, instead of fair value. Who's right? The one who's right is the group, right? Because we are going from combined group, right? So what you're gonna do firstly is you're gonna remove that obviously depreciation relating to the um to that item, right? To the investment property. You're gonna remove it, and then you're gonna record the fair value gain because that's what's supposed to be recorded. Like I said, this thing is just about fixing discrepancies. Once you understand this fixing discrepancy part, you'll never get it wrong, right? So that's it. Then after fixing these discrepancies, the last thing that's left is allocating those fixed amounts. So those amounts now are fixed, right? Those correct amounts to what? To the NCI. And as you can see here, when we are busy with the main elimination journal entry, we did allocate something to the NCI. However, at acquisition, you remember, now we have to allocate everything from since acquisition to the end of this year, right? So that's basically it. That's how you account for groups. So now we are going to move on to a question, right? So going to move on to a question. So let's come here. Okay. So this question, this is last year's fourth test, right? So this is last year's fourth test. And okay, let's start with it. Let's do it. Right. So firstly, it says the following information was extracted from the accounting records of um toppers in sprinkles, right? So do you see that they said toppers in sprinkles, right? Okay. Then for the reporting period ended 31 December 2020, right? Then they gave us information here of topper and sprinkle. Now, what do we see also? We see this investment in sprinkles, right? So we know that topper actually bought shares from sprinkles, right? From the statement, because we see his investment and they're telling us that it's at fair value, right? So at fair value, it means that it's not this amount here, it's not that consideration amount, right? Because like I said, in the separate, you're gonna have this amount here for the investment, right? Like they did here. Do you see this amount for the investment? However, this this amount, like I said, it represents what the consideration. However, in this case, this is not the consideration. Why? Because it's at fair value. If they said cost, then it would have been this consideration at fair value. So at fair value means that they did record this journal entry first. However, as time went on, so as time went on, they started recording also fair value adjustments on this investment, right? So after maybe they had something like debit investment, credit gain on fair value, right? That's what they had, right? That's what it means. So let's move on. Okay, reporting period that, right? So most probably because the reporting period is ended that our year, so our reporting year is going to start from the 1st of January 2020 to the 31st of December 2022. Most probably they want to ask us to consolidate for that for that period, right? And then okay, I just wanna come here. So the required says prepare what pro forma journal entries. Do you see? So those fixing and allocating journal entries relating to intra-group transactions. So you're telling us straight intra-group transactions, and where are intra-group transactions? I said they are here, right? They are here, number 5. These are intra-group transactions, fixing these discrepancies. These are intra-group transactions. And then telling us between Topper Limited and Sprinkles that need to be taken into account when preparing the consolidated financial statements for the reporting period ended 31 December 2020. Like I said, which means the reporting period is from 1 January 2020 to 31 December 2022, right? So they're telling us that please note that show all calculations as marks are awarded. Yeah, like I always say, please, when you're doing questions, always question papers, you must always have a page where you answer and a page where you do calculations, because it doesn't matter if they don't see those calculations, you're not going to get the marks, right? So please have that page, and most probably in that page you're going to also have your analysis, right? So please learn to write everything down. Like don't calculate using your head, or don't think like in the test you don't have time for that, right? Yeah, and then scratch later if you don't want it. Yeah, and then the entity, okay, entity references are required. Okay, when they say entity references, they just mean this one comes from the parent or this one comes from the subsidiary. And then they say general narrations and financial statement references are not required. So that thing of this thing goes to the statement of financial position, right? It's not required, that bracket, right? And then the general narrations are also not required. So now they told us that for the intra-group transactions, right? Right. So they said with the intention to expand its operations and diversify its group, the executive board of Toppers unanimously agreed to invest in the ordinary share capital of Sparkles Limited, right? An agreement was reached and concluded last year. Do you see this last year, right? Because this year is 1 January 2022. And please, from now on, like read dates that way. Read dates with reference to the current year of assessment, right? Whether it's 4 months into the year of assessment or last year, read it like that. And so it was bought last year, this entity, and it was purchased for um 1,725,000 So they bought, I mean, 1,725,000 ordinary shares for 2 rand 75 per share, right? So what happened is at this date, so 1 January 2019, what did Topper Limited record? He recorded, firstly, he said he debited what? He debited investment in Sparkles, right? Investment in Sparkles, and said 72500, right? Multiplied by the 2,75, and then we get 4,743,750. So that's the first thing he recorded. He said debit Sparkles with that amount, and then we credit what bank, because I think they used, yeah, when they said for that amount, so they didn't tell us what consideration method they used here. So that means that consideration was not the focus for this question, right? And then, okay, that's basically what they told us. They told us what we bought, but that's not really relevant because we are doing intra-group transactions. So let's move on. They said on the acquisition date, all assets and liabilities carrying values, all the assets and liabilities carrying values of Sparkles were deemed to be equal in their fair values, to be equal to their fair values. Do you see? So do you see that the carrying amounts were equal to their fair value? So there were no fair value adjustments. So you don't need to think about fair value adjustments. So fair value adjustments obviously are number one of this framework, right? I mean number two of this framework, fair value adjustments. And then fixing discrepancies as a result of these fair value adjustments is number four, right? That means that because we don't have this number two, we won't have number four, right? Because there were no discrepancies at the beginning value of the year, right? Continue, right? And then okay, they said since acquisition date, Topaz and Sparkles had purchased and sold items within the group. The following transactions were noted between the entities, right? So do you see that they're telling us that they are intra-group transactions, right? And do you see when did we buy the company? We bought it last year, right? So at acquisition is last year. Then since acquisition also starts from last year, 1 January 2019 until where? December 2020. And you'll see why I talked about that. So let's start with the first transaction. So do you see that? What does it mean? What is this question saying to us? Do you see now that we know the framework, basically? We know exactly where we are, right? We know that these general entries are not necessary, these ones, because they asked for intra-group transactions. Mean elimination journal has nothing to do with that. This thing has nothing to do with that. Number four has nothing to do with that. Number five is intra-group transactions, because what happens after is intra-group transactions. So I didn't write it here, but just to illustrate, this is intra-group transactions, right? These are intra-group transactions. So you know exactly where you are. So if they say they want intra-group transactions, you know that you must not start with the main elimination channel entry, right? Or fixing these discrepancies as a result of the fair value adjustment, right? So even if you had fair value adjustment, you must not have done these journal entries, because even though they are pro forma journal entries, they are not intra-group related, right? So intra-group is when entity A sells to entity B, like I showed you here. Entity A sells to entity B on inventory or assets, or dividend distribution, because you see that entity B is distributing to entity A, right? So there are transactions between these entities, right? So that's what they mean when I say intra-group transaction. So we know exactly where we are, at least, right? So now we know that we are basically reading the correct set of information, what's necessary. So it says here, transaction one. Now, for this thing, for 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 this part, so for since acquisition, I'm gonna teach you two ways of doing it. I'm gonna teach you two ways of doing it, and they both work. One is longer, one is short, right? The shorter one, you see it's used, is the one that most lectures relate to you, so they tell you, right? Then the longer one, they don't really do it with you. However, the reason why I also do the longer one, the shorter one, basically it's done using, I would say, formulas, because they are telling you exactly what to calculate there. But with the second one, it's done more with understanding, right? So the second one is more with, and that's why it's longer. And the second one, the reason why I introduced it, and also when doing questions, I don't suggest you use, of course, the long one, right? However, you have to know the long one to see how they actually got to this short method, this shortcut method that they are using, right? And then use their method from there on. However, you know how to get to those numbers, right? Without actually using um those formulas, right? You can get to those answers using just understanding. That's the point I want to make, because um um I'm not sure the level of complexity in terms of like group accounting, how far they can go with you guys. However, what I've realized is that if you do know how to do the long way, even if you do have complications with the short way, at least with the long way, you will spend, even though you're going to spend like 5 minutes or 3 minutes, right, on it, at least you are sure that your journal entry is perfect. So instead of wasting time thinking whether your journal entry is perfect, if you want to check your journal entry, use the second long method, right? So let's firstly start and discuss what happens to these intra-group transactions before we continue with the workday. So with intra-group transaction, so the first thing is if there's sale of inventory, right? So if there's a sale of inventory, firstly, the parent must firstly eliminate the sale, right? Because you can't sell to yourself, right? So that revenue, so you must firstly eliminate the balance of revenue relating to that, because you cannot sell to yourself, number one, right? And number two, the parent must also eliminate the unrealized profit, right? And I will teach you how to calculate the unrealized profit, right? It must also eliminate the unrealized profit. Let me show you the concept where this unrealized profit comes from, right? It also comes from this concept here. It also boils down to this concept here. So we have these two entities, entity A, right? And we have entity B, right? Let's say entity A sells to entity B, right? And of course, entity B takes this inventory and sells it to outside parties, right? So entity B takes this inventory and sells it to outside parties, right? So we have third parties here, right? Let's just call this entity E. It sells it to entity E. So this is the group A, or the A group, right? As group A, or the A group, right? So let's look at what happened on a, so firstly on a separate level, then on a group level. So what happened on a separate level? So A, um, A sold inventory to B, right? And obviously, when A sells inventory to B, what's going to happen? A is going to put a markup, right, on what? On that inventory and sell it to B, right? And B is going to take that inventory and also put a markup on it and sell it to E, right? And sell it to E, right? Now, do you see that if A, so A sells, so let's say A sells 100 rand worth of stock to B, right, for 150. So that stock is worth 100 rand. So obviously the stock you got it from outside parties. A got it from outside parties for 100 rand, and then he sells the stock to B for 150 rand, right? So do you see that he added a markup of 50 rand because he wants to make a profit, obviously. And B sells, but he doesn't sell the entire thing, B. So B does not sell. So B, he chooses not to sell the entire thing, right? Right. He chooses to sell, let's say, only half, right? And he sells this half. Now let's firstly say he sold all of it. So he sold all of it. Let's say he sold it for 250, right? For 250. Let's look at what happened in reality, right? Do you see that what happened in reality is that A bought stock worth 100 rand, right? And sold this stock worth 100 rand for 250 rand. That's what happened on a like group A level. Because what happens inside here does not matter on a group A level. What matters is what came in and what eventually came out, right? That's what happens. The transactions between A and B, they must be deleted, right? They must be fixed. Why? because we said from a group level, you are one entity, so you can't sell to yourself, right? So when they are talking about unrealized profit, it's something like this. Let's say, so that's when you sold everything. Let's say you didn't sell everything, you sold maybe half of the stock, sold it for 100 rand, right? So because you sold only half of the stock, do you see that the cost of sales is not this 100, right? Because you sold basically half of this. So you sold, in essence, what happens is that you sold 50,000, right? So you have 50,000 cost of sales, right? And then a revenue of 100, right? Not whatever happened here. Whatever happened here doesn't matter, right? This is what really happened on a group level. So what must we do? We must delete what happened here and record what happened here, right? That's the main concept for it, right? And these basically formulas that they give you. So here, the first one for inventory, what you have to know is that first you have to eliminate the balance and then eliminate the unrealized profit. For assets, you have to just eliminate the unrealized profit, right? And then for um, dividend distribution, you just have to eliminate the dividend distribution because you can't um, um, uh, yeah, pay yourself dividends, right? So let's now go back here, right? So let's see. It says Sparkles purchases inventory. So firstly, like I said, I'm gonna use their way of doing it, and then I'm gonna show you the long way. So Sparkles purchases inventory at cost, at a cost plus 40% from Topper, right? So Sparkles purchase inventory from Topper. Do you see? So we have Sparkles here. So here we have Sparkles, and we have Topper, and then Sparkles sells to Topper, right? Right, and then here we have um T group, right? So this is Topper, the Topper group here, right? And then what do they tell us here? That year, what happened? Sparkle sold to Topper, right? Then Topper sold 75% of that stock to outside parties. Obviously, if you sold it to outside parties, then they, if you sold everything to outside parties, then we don't need to do anything. So if in that year you did sell it to outside parties, we didn't need to do anything. However, do you see that in that year, Vele, as sold to T, they didn't sell it to, they didn't sell everything to outside parties, right? Right. So that means that you have to take out the balance and the unrealized profit, right? If it was just a sale between them, and the T sold 100% of the stock, what was gonna happen is that you're just gonna have the pro forma journal entry eliminating the balance, right? Like I said, for inventory, there's two sets of pro forma journal entries, one that eliminates the balance and one for unrealized profit. So firstly, you're going to start with the one that eliminates the balance. So that one is simple. All you have to do is check the sales, like the sale that happened that year. You just eliminate the total sale, right? So it's for eliminate. So you're going to debit what? Debit revenue, right? You're going to start by debiting revenue, right? However, before we can even go here, right? Don't forget, and when you're in the test, the thing is here is just difficult to keep up with it. But when you're in test, please have a timeline because I almost forgot something, right? Do you see that this information relates to what last year? Do you see here, right? And of course, last year's balances have already been taken into account. So that revenue what has already been taken into account. So we don't need to eliminate um um okay, before we talk about elimination, before we talk about elimination, so before we go on here, so what happens is, like I said, if you didn't sell that year, you have to eliminate the unrealized profit, right? But what happens is next year, 25% of that stock, you are gonna sell it to outside parties, right? You are gonna sell it to it. And what must you do this year? Now you have to realize the 25%, right? Because last year you unrealized it. This year you have to realize this 25%, right? So the year that it happens, you have to unrealized that so you have to take out the unrealized profit, right? Because the profit is unrealized, and then next year it will all be sold. So you have to realize it this year, right? So do you see that this thing occurred last year, right? So because it occurred last year, this year we just have to have journal entries that show what the elimination, right, from last year's profit, and basically the realization of this year's profit, right? Because what happens is that that profit that we are supposed to record, we didn't get it last year, right? We actually got it this year for the 25%. So for that 25% inventory, we actually got it when this year, right? We actually got it this year. However, before I do this one, before I do, because this one is a bit more complicated because it's dealing with next year's things, I just want to let's deal with point two first. Let's deal with point two first, and then I'll come back to it, right? Because it uses the same principles. So point two is what happened this year, right? So they said this year, current sales are 550. Like I said, firstly, we started the balance. So you're going to say debit, because it happened this year, right? Debit what? Revenue with 550,000. Why are we debiting revenue? You can't sell to yourself. That's what they use. So 550,000. So you're gonna have your 550,000 here, debit revenue, and then credit what? Credit cost of sales, right? And this revenue, where does it come from? It says Sparkles purchased, right? So purchases inventory. So who's selling? The parent is selling, right? So the revenue comes from the parent, and then just know that the cost of sales will always come from the opposite of the one that has this revenue. So here is going to be for the sub, right? The sub. So if here it was the sub, then here is going to be the parent. Same amount, 550,000. So that's where you start. That's the journal entry you start with, right? And then the second journal entry that you do is the one for the unrealized profit, right? Now for the unrealized profit will always be, and for inventory, right? It will always be for the inventory that's not sold, right? The inventory that's left, right? Because that's the unrealized part, right? The reason why it's called unrealized is because why? From a group perspective, right? Let's look at this. Let's look at the stock that was sold, the 70% stock that was sold. From a group perspective, it makes sense, right? Because you did sell the 70%, right, stock, right? So therefore you are entitled to that profit, right? You're entitled to that profit. However, for the 30%, you are not entitled to that profit yet. Why? Because you haven't sold to third parties, and as a result, it was for that 30%, it was just a transaction between who and who, between the parent and the subsidiary. And we say transaction between the parent and the subsidiary only. It doesn't make sense because the parent and the subsidiary is one entity, right? Therefore, that's why we have to fix that discrepancy, right? So that's why we have to fix also this discrepancy relating to the inventories, right? So we see that it's 30,000, right? That's left, right? Now, this unrealized profit, the easiest way to calculate it, it's via inventory. So for sale of inventory, the easiest way to calculate the unrealized profit is to calculate the inventory discrepancy. As you can see, and this is basically I'm just telling you something that you just need to note down. So with in inventory, like with inventory, because inventories because entity, so because like in this case the parent is selling to the subsidiary, right? Because the parent is selling to the subsidiary, right? The parent is going to what? Add a markup, right? It's going to add a markup on the inventory, and as a result, what happens? What does it mean? It means that that inventory, the inventory that you're gonna have, right, in our balance, right, it's gonna be what? It's going to be always higher than it's supposed to be. By what? By that unrealized profit. You understand? So the inventory amount will always be higher, right? It will always be higher by that unrealized profit amount, right? So the unrealized profit amount, right? So that's why it's easier to calculate the unrealized profit using the inventory. So how do you do it? Firstly, we know that the unrealized profit is where? Unrealized profit is contained in the inventories that were not sold. So in the what closing stock. So it told us that closing stock was 30%. So that the inventory was not sold, right? So we're gonna say 55, 550,000, I mean, multiply by 30, multiply by 30%, right? Multiplied by 30%, right? So that's the inventory that's left is 165,000, right? So that's the inventory that's left. Now, this inventory, right? Is it the correct inventory amount? No, it's not, right? Why? Because this 550,000, this 550,000 is actually what? It's actually the cost plus the markup of 40%, because why? It's the total sales. There's the sales that Topper made to Sprinkles. So because Topper sold to Sprinkles, right? He added this 40%, right? So if he added 40% here, right? We can start firstly by removing it here, right? So we can just say, so ignore that amount that I just did. So 550,000 multiplied by, what do you want here? You want the profit generated by this basically amount, right? Because we want the unrealized profit. So the profit generated by this amount, how much profit did they get? It's 40. You say 40, what you want, right? Times 40 over 140 over what you have. So that's basically the profit, right? Or you can just use the 600, so 600, 165,000 that you had, right? By saying that 55,000, because it's 550,000 multiplied by what? 30% of the closing stock, then you get 165,000, right? What is that? That is the closing stock according to who? According to Sparkles, right? However, you know that that inventory amount, that 165 amount, is actually overvalued, right? By what? By the profit, right? It's actually overvalued by what? By the profit. So now we can use this 165,000 to calculate what? What what is it overvalued by? What is the profit that is overvalued with, right? So we said 165,000 multiplied by what? What we want, which is the profit, right? Want the profit, unrealized profit, um, divided by what we have. What we have is the cost price plus the 40%, right? We have the selling price. The selling price is that one. So then we get, so what we get here at the end. So the amount that we get here at the end here. So what we actually get at the end is 47,143, right? 47,143, right? That's the amount we get, right? And then firstly, we're gonna do what? You're gonna say, like I said, the inventory amount is overvalued, right? So we're gonna say inventory, you what? You credit with that amount, that 47, and then cost of sales, you debit with that amount. Now, this is also very important for also since transactions, you must not forget deferred tax. Do not forget deferred tax. And like I said, deferred tax of groups is simple, right? All you need to do is, do you see this one? This one does affect. So you're gonna look at every balance that affects profit, right? That affects profit, right? Or retained earnings. So if it's a balance that affects profit or retained earnings, you look at it, right? So do you see that revenue and cost of sales will affect profit, right? But however, they will both affect profit, right? They will both affect profit. So here there's no deferred tax for this journal entry, right? However, let's look at the next journal entry. Next journal entry, we have that cost of sales and then inventory. Like we said, cost of sales, we debit, right? With the 47,143, and the inventory we credit, right? With the 47,143, right? That's what we said. So do you see that in this case, inventory is SFP, right? But cost of sales is P&L, right? What's the cumulative effect they on profit? Is that 47,143? Do you see? So you're gonna just look at all of the general entries that you have for deferred tax. You're just gonna look at all the general entries that you have and look at their cumulative effect, right? You're gonna look at what? The cumulative effect. And as a result, what are you gonna do after you've seen basically their cumulative effect? So after you've ascertained their cumulative effect, what do you do? What you do is you do the opposite. So for deferred tax, what you do is you do the opposite. So here they did what? They debited what? Cost of sales, right? They actually debited a profit amount, right? So for deferred tax, you're gonna credit a profit amount. Also, deferred tax has two balances, right? For deferred tax, it's either you are debiting deferred tax or crediting deferred tax, but the contra account that goes with deferred tax is what? Is always income taxes, right? So in this case, what I'm saying is the first line entry, do you see? We are just gonna look at how does it affect profit cumulatively, right? So cumulatively, this one affects profit zero, right? Because it's a debit to profit of 550, credit to profit of 550 has no effect on profit, no deferred tax. Next line entry, cost of sales is the only one that impacts the profit, right? Because inventory is SFP, right? So what is the cumulative effect of it? It's a debit, right? Debit of 447,143. That means that for deferred tax, you have to do what? The opposite, right? So we take that amount 47. Yeah, we take that amount 4790, 4743 multiplied by what? 28%, right? And then that's your deferred tax. So the next channel entry I'm gonna process there is basically you're gonna say agree the cost of sales that profit had a debit balance. So what you're gonna do is you're gonna credit income taxes. Obviously, like I said, you do the opposite by creating income tax. Why? Because now what are you doing? You are crediting a profit and loss account, right? That's the opposite. So there it was debited for cost of sales. Now you're crediting it, right? And then what obviously are you gonna debit? Um, deferred tax asset, right? Deferred tax asset. So that's what they did here. As you can see, do you see that the revenue balance, it was eliminated, right? Like I said, firstly, you eliminate the balance because it's inventory. And then secondly, you recognize the you eliminate the what? The unrealized profit, I mean. You see this is how they eliminate the unrealized profit. And then don't forget the deferred tax for it. Do you see the deferred tax is just the reverse, right? Here we have that cost of sales, right? And here we have the reverse, right? And then that's for this year, right? Now let's look at that part, that portion that talks about last year, right? So do you see that this portion talks about last year, this one of the 75%, right? Now, because this thing happened last year, if it happened last year, that means that you see that this balance of revenue and cost of sales, they won't have it, right? So you don't do it. You don't record this balance here, number one, right? You don't record this balance, right? Number two, firstly, you still have to record what? The unrealized profit, right? Because what did I say? I said pro forma journal entries are always scrapped year after year. So even though most probably December 2019, you prepared consolidated financial statements, right? They are scrapped. This year we have to prepare new ones, right? And because you have to prepare new consolidated financial statement, you have to also record what happened from since acquisition, right? So do you see that that transaction happened last year, right? And because it happened last year, there is no balance. So the balance part, you don't need to worry about it. The only thing you need to worry about is the unrealized profit. So the first thing is recognizing the unrealized profit. So how do you normally recognize unrealized profit? You said cost of sales, you debit, right? And then you credit inventories, right? This time, because it happened last year, right? Where is that profit contained? Because cost of sales goes to profit and loss. So because it happened last year, is it contained in profit or in profit or loss? No, profit or loss, it works with amounts that happens this year, right? So it's not contained in profit or loss. That amount is not in profit or loss. It's actually where retained earnings, because amounts at the end of the year of profit or loss are taken away to retained earnings. So it is way in retained earnings. So what are you gonna do? You're gonna do the same journal entry, exactly the same journal entry you would have done last year. However, replace cost of sales with retained earnings, right? Because there is no profit or loss. right? That thing is already taken to retained earnings. So it's retained earnings, and it's so if you're doing journal entries, then it won't be P&L, it will be SCE because that's where it is, right? So the first journal entry we're gonna have is debit retained earnings and credit what? Inventories, right? With what? With the unrealized profit. Now let's calculate the unrealized profit here, right? So the first thing, what did we say? We said the unrealized profit is contained where? Is contained in the closing stock, right, of the inventory, right? So the closing stock here, they tell us is 25%, right? So when I say 380,000 multiplied by 25%, right? Multiplied by 25%, that gives us 95,000, right? And don't forget that we want the unrealized profit, so multiplied by 40, which represents the profit what we want, then over what we have, like divided by 140, right? The amount that we get there is 2,743, right? 27,143, right? So what you're gonna do is gonna debit retained earnings, right, with the 2,743, right, and then credit inventories with the same amount, 2,743, right? And then there is obviously there you are eliminating last year's unrealized profit, right, in the journal entry. And then the second journal entry I'm gonna do is what? Remember what happened this year. This year now, this inventory was sold, right? This 25% was sold. So how do we recognize this year's balance, right? By saying this, we're gonna do what? We're gonna debit inventory, right? So you're gonna debit inventory, right? So basically, realization is like opposite. So debit inventory, right? And then credit what? What are we going to credit, right? What are we going to credit here, right? We are going to credit a profit or loss item, right? So profit, because we've realized this profit this year, right? So you can credit profit, or another account they like using here is cost of sales. So you can credit cost of sales, right? Yeah, right. But that's just a profit item, right? So, and this journal entry, so where you debit inventory and credit the cost of sales or the profit, so that's the unrealized profit. That's where you don't eliminate the unrealized profit here. You recognize, right, right, the realized profit. So that's where you recognize the realized profit, because this profit was realized this year, right? So that's how you do it. Those two journal entries, debit, retain earnings, and then don't forget, ne, do not also what? Don't also um do not also forget, ne, that there's also what? Deferred taxes, right? Do not forget deferred taxes. Do not forget deferred taxes, right? So on your profit amount, so your profit or loss amount, do not forget deferred taxes. And then what happens is, do you see that they have a combined journal entry, right? So as you can see, this combined journal entry, this is just the combined version of my journal entries, right? Because the first one I did is retained earnings. You credit what? Inventory, right? And then the next one, you debit inventory. Do you see that the inventory that I credited in the last journal entry is gonna be basically eliminated by this inventory that I debited, right, in the next journal entry, right? So it's going to be canceled out. So the only thing that's going to be left is the retained earnings and the profit, right? Which is here, retained earnings and the profit. And then do not forget deferred tax, right? Because deferred tax will always follow what? Do not forget. Deferred tax will always follow what? Will always follow what the profit does, and the opposite of profit, right? So it will always do what the profit does. However, but the opposite basically effect of it, right? So the opposite effect of it, yeah. And then you get this deferred tax, and then this deferred tax obviously relates to what? So it relates to this. So Okay, so as you can see here, we're gonna have two deferred tax amounts, right? One relating to this retained earnings amount, right? And one relating to the cost of sales amount. Like I said, every time you see a profit item like retained earnings, although it's not profit, but it's past profits, right? So because in this first journal entry, you debited retained earnings and created inventory, right? It's in effect, you have this debit of 27,143 that affects profits, right? So therefore, you have to have a deferred tax what? So you have to, because you debited it, you have to credit what? Income tax. And if you credited income tax, because that's the account that affects P&L, what we have to debit? Deferred tax asset. That's why we have a deferred tax asset here, right? And then with cost of sales, on the other hand, right? What happened is that inventory still is an SFP amount, so you won't consider it. Cost of sales, there we credited it, or for the profit, basically, we credited it, right? So now it has a credit balance, right? And we said deferred tax is always the opposite. The opposite of this, it will be debit. So you're gonna debit income taxes, P&L, right? And then credit what? Credit deferred tax, SFP, like they did here, right? So that's how that one was done. I hope you get the whole point of the unrealized profit right here. And then now we go to so after that, so let's see if they have any other transactions. So here, okay, we are told about the machine. So Topper purchased a coloring machine used by Sparkle. So that's basically in unrealized profit for inventory, right? Unrealized profit for inventory. And then here they tell us that Topper's purchased a coloring brush machine used by Sparkles in his production factory. This purchase was purchased with the intention of resale to Deco Admira, one of Topper's regular customers. At the end of the reporting period, the machine was not sold yet and was correctly included under inventories in Top. Now, before we continue with this one, do you see here they told us the Sparkles owed Toppers 150,000 for the inventory purchased, right? So do you see that? Which means in the records, right? What do they have? They have that Sparkles owes Toppers, right? So if these inventories are not bought cash, ne, they are bought using obviously credit, then what you're gonna do is do not forget to eliminate the balances, right? Because essentially what you have is this 125,000 as a receivable, right? For top, right? As a receivable for Topper and as a payable for Sprinkles. So what you have to do is remove that receivable from Topper by crediting it and then debit the payable, right? Debit the payable, right? And that's what they did here, right? And then debit the payable. That's what they did there, right? And then okay, they said on 1 December 2020, so that's this year, right? 1 year before year end, right? The machine was purchased, so it was used by Sprinkles. It was purchased with the intention of resale to the economy. One of Topper's regular customers. At the end of the reporting period, the machine was not sold yet and was correctly included under inventories, right? So they're telling us that Topper, basically for Topper, this machine is inventory, right? So we are here given the cost price of the machine, the accumulated depreciation, and the purchase price by Topper, right? So now we have to think of this. Now, what is this? Do you see that this is the second part? This is what? A sale of assets. And what did I say of sale of assets? Sale of assets, you only consider the unrealized profit. So there is no balances or stuff like that. Only consider the unrealized profit. And how do you consider the unrealized profit? This one is actually much more simple to consider the unrealized profit because the unrealized profit is the actual profit, right, on sale of the asset, right? So let's look at the profit on sale of the asset. So the asset, the carrying amount of the asset, you see it was 70,000, right? Carrying amount of the asset was 70,000, right? Then top up paid this amount, right? 75,000. So do you see that basically Sparkles made a profit of how much? Of 5,000, right? From this sale. It made a profit of 5,000. And because Topper hasn't yet sold this machine to customers, right? So it's not yet outside, it's still there, right? Do you see that this profit is still unrealized? However, even if he still sold it to um outside parties, that first journal entry of the elimination of unrealized profit, you have to do it, right? So as you can see here, let's just go back here. So the 5,000. So in Topper's book, what do you have? You have you credited profit on sale of asset, right? Profit on sale of asset, and then what happened is you created the profit on sale of asset, and the asset itself is worth more, right? The asset itself is also worth more. So what's going to happen is that you're gonna firstly eliminate that profit by saying what profit you debit, that profit on sale of asset you debit 5,000, right? And then you're gonna credit the machine, the asset, right? So that's the first elimination journal entry, like they did here. This time it was inventory. Do you see? The asset was inventory. They told us it was correctly recorded as inventories. And then this other income that they use is the profit on sale of asset. You could use other income, but I suggest you just use profit on sale of asset because that's what they said in their statements, right? And then after that one, do not forget that where is this thing? Okay, I think it's a bit okay. Okay, here it is. Okay, so now do you see that um basically because it's with Topper, now it's recorded via using IFRS 16 rules, right? So we don't even need to think not IFRS 16, man. I mean now it's going to be calculated using IS2 rules, right? In inventories, right? It's gonna be calculated using IS2 rules, right? So there's no depreciation. You don't have to consider that. So we just have to consider this unrealized profit, right? So what happened, it was this year and it affected the profit, right? So we look at the journal entry. What part of the journal entry affects the profit? Obviously the top part, right? But the part containing the profit on sale of the asset, right? This part here, right? Because this part influences it. When you are thinking of deferred taxes, what we're gonna do is we are gonna firstly say I guess this thing is debited, right? 5,000, the profit. So you're gonna have to credit the profit. So credit income taxes with an about this amount, 5,000 multiplied by 28%, and then we're gonna credit. I mean, we credited the income tax, so we're gonna debit deferred tax asset, right, with the same amount. And that's what they did here, right? And then, right, that's what they did there. And then, as you can see, also by these statements, right, that Sprinkles, right, actually paid dividends. Do you see? Sprinkles actually paid dividends of 85,000, right? So Sprinkles paid dividends of 85,000, right? How much of Sprinkles do we own? How much of Sprinkles do we own? Let's check. How much of Sprinkles do we own? So in terms of the amount that we own of Sprinkles, what's the percentage that we own? Wait, where is it written? Well, the percentage that we own. Okay, it doesn't seem like they wrote it anyway. It doesn't seem like they wrote it anyway. So most probably this question they didn't have they didn't have it on them because they're supposed to tell us the percentage, right? They're supposed to tell us that's the percentage, right? Maybe they were told in class or something like that, or it was sent to them again. However, the percentage here it's 75%. So um basically Toppers owns 75% of Sprinkles, right? It owns 75% of Sprinkles. So now you can determine it. You can determine it. You can determine it. Um, you can determine it. However, let's see here, because they said you purchased ordinary shares, right? However, do not use that method. They are supposed to tell you. Yeah, they're supposed to tell you. So if you know that it's 75%, right? If you know that it's 75%, now that you know that it is 75%, all you have to do is come here, right? So come here. So yeah, all you have to do is come here. And then when you are here, what do you do? Right? Don't forget that you can't issue dividends right to yourself, right? So we have to firstly eliminate um basically the dividends that we got, right? Because we recorded dividends. But we didn't get this 85,000, this total 85,000. What Toppers got is that 85,000 multiplied by 75% that they own, right? Because that's what they got, right? Which is 63,750, right? That's what they got, right? And then the rest you have to attribute it to the non-controlling interest, because that's for the non-controlling interest, right? That's their interest. And then that's where this account comes from. So this one we are eliminating. So we are fixing our balance, because you can't issue yourself dividends, right? Can't issue yourself dividends. And then the non-controlling interest, we are attributing a portion of it to the non-controlling interest, because we also distributed this dividend to the non-controlling interest. And then this is the dividend paid, right? Dividend paid, we have to mm, basically take it out, this dividend paid, right? Because you can't pay dividends to yourself. From a group level, you cannot pay dividends to yourself, right? That's why we are removing it. You can't pay yourself dividends, right? And then continuing on further, I just wanted to put this last point, right? Because I won't really continue with other questions. I just wanted to put this last point. If they say the investment in that entity is at fair value, don't forget that for that first part, this first part for the, do you see that these parts here? This one, okay, it won't influence anything here. Yeah, this thing won't, yeah, this thing won't, yeah, this thing won't influence anything. It will not influence anything there, right? This investment at fair value will not influence it there. However, it will influence it here for the main elimination style entry. Why? Because you see that we are crediting the investment, right? And because this is the key, this investment, when you credit it here, it has to be at carrying value here. Not carrying value, I mean, it has to be equal to this amount, the same amount here that you got here, right? When you're doing this main elimination general interest, this amount here has to be equal to this consideration at fair value. It has to, right? Now, in this question, do you see that they said fair value? If they said at cost, then you know definitely this amount is equal to um this the you know that basically this amount is equal to the carrying amount at fair value, carrying amount at fair value at acquisition, right? However, they said it's at fair value, so you know that there are fair value adjustments in this amount, right? So what you are going to do, the first thing that you are going to do is you are going to firstly subtract all of the, so take it out. So if you accumulated like the profits in there, you are going to firstly take them out, reverse them, right? Reverse them, right? So something like this, like they did here, you're going to reverse them. Do you see? Because what happens is that during the year, you've been saying what, because you've been adjusting it, you've been debiting the investment and then crediting the market to market. That's why this market to market reserve is like this, right? So just for interest sake, the mark to market reserve, it's for mark to market. I mean, mark to market reserve is for instruments, right? So for measuring instruments. So for fair value adjustments on instruments go to market reserve, right? And then obviously if it's like on land or something, it's a revaluation surplus, right? And then this is that relates to this year, right? So Do you see that these are fair value adjustments, right? That relate to this previous year, right? And this year, right? Why? Because we want this investment amount to be equal to what? The investment amount at what? At what? At you want it to be equal to the investment amount at cost, right? Why? Because you want it to have that consideration at fair value. And I want to show you here that it gives you that consideration fair value. So let's take that 6 million, right? 6 million minus what? This general entry that they did here, minus the 299,500, right? Minus 473,000, right? Minus that, you'll see that the amount that you actually get here. Understand? So it's this 43, right? 999,500, right? You'll see that the amount that you have at the end, do you see that they are taking out what amount? This 4,734,750, right? And this amount that they are taking out is what? Do you see that this amount is the actual what? Consideration. Let's go up and let me show you that is the actual consideration, that amount, right? What did we say the consideration is here? We said it's 1,725,123, right? 1,725,00, right? Then multiplied by 2,75, right? That gives us what? It gives us this amount. It gives us this amount because, like I said, this amount has to be the consideration, right? It has to be the consideration, right? That's how they do that one. And then something else that I wanted to show you before I close up. So they say, you see, they say the non-controlling interests are measured using their um, proportional net assets and liabilities, right? So let's look at, like I said, proportional net assets and liabilities. You just add these ones, so you're gonna see 4.6 million, right? You add all of the equity, right? Because so the only equity you have is share capital and retained earnings, right? You add all of the equity, like I said there, that is equals to 6,128,500, right? And then you multiply that by the non-controlling interest, which is 25%, right? Non-controlling interest is 25%, which gives us this amount. I hope that was clear. And then, yeah, in terms of continuing with groups, I am going to send basically a last video, but that's going to be on a third year BEC level, right? Gonna send the last video, but it will also touch on everything. If you want further detail as to how to do this thing, I suggest you also look at that video, because I'll be covering also another question in that video. Otherwise, I hope you got as much as you can from this session, and yeah, see you guys next week.